Question number 6. The following are the balance sheet of Tamil Nadu Industrial Corporations Limited. Balance sheet is there. Reserves and surplus. The uniqueness of the problem is during the current year ended 31st March, a dividend 19,500 was paid. That is usual. The assets of another company were purchased for 37,500. Payable in fully paid up shares. 37,500 rupees worth the assets purchased. Further, the payment is only in the form of equity shares. The assets are being stock, machinery, and goodwill. Is that okay? All these things are being not cash. So the conversion happens between non-current assets other than cash as well as equity shares. It's not falling under cash flow statement. It will not fall under cash flow statement. Is that okay? Now, so we have adjustments for stock, machinery, and goodwill. Stock, machinery, in plant and machinery, and goodwill. In these items, we have adjustments. I just put the dot. In addition, plant at a cost of Rs 4,237 was purchased during the year. Following depreciation was written off during the year on property and machinery. So for machinery, we have 2 adjustments, 3 adjustments. And for property, we have only 1 adjustment. Okay. Income tax during the year amounting to Rs 21,578 was charged to the provision for taxation. Net profit for the year before tax being this one. So whenever the profit given in the adjustments, don't worry about that. So there is a tax payment also. I'll put the dot here. Yes. Come on. Prepare the formats along with me. Now, so cash flow statements. Cash flow statement. Yeah, join with me to solve this. Cash from operation, cash from investing, cash from financing, adding the 3, cash from operation, cash from investing, cash from financing, with that opening cash balance is added. Then you will get closing cash. Then you will get the closing cash. Clear? Let me finish up posting the items given the adjustments first. So notes to accounts. GR. GR. 22,500 becomes 30,000. What does it mean? Transfer to GR from the P&L account. Transfer to GR is addable item. 7,500. If you post the difference, then the entry regarding these two already over. In case of profit or loss, the difference between these two is the current year's profit. Find out the profit for the current year. 1,147. In case of trade payables, trade creditors 29,250 increases to 31,245. Then you have the cash balance higher due to this. You settle later. Increase in creditors. What is the value? 1,995. Bills payable decreases. You might have paid. Cash outflow will be there. 17,092. Then in case of non-current assets, as we have the adjustments, it's better to open that separately. Property account. Opening balance 1,11,375. Closing balance 1,08,187. And machinery opening balance should be 84,713. Okay, I posted wrongly. So opening balance 1,11,375. Closing balance 1,08,187. Machinery opening balance 84,713. Closing balance 94,650. So with that, notes to accounts completed. This one not required. From here I am going to record. Let me first finish off liabilities related items. Share capital, we have the adjustments. Share capital. Equity share capital. Opening value being 1,65,000. Closing balance being 2,02,500. And reserves and surplus already taken. Trade payables also taken. Bank overdraft 45,000. Initially we have 45,000 rupees. Okay, do you have the cash balance? Yeah, cash. It could be a part of cash alone, so you can merge with the cash, bank, and marketable securities. Or the other way, you can treat this being the current liabilities. Both the way you can handle. Is that okay? Anyhow, 50,000 reduced. I consider this being the reduction of current liabilities. Reduction of current liabilities, nothing but settlement of the money. So cash will go off. Bank overdraft. 45 becomes 0 now. 45,000 paid. Minus item. Then we have provision for taxation. Provision for taxation. Opening balance being 30,000 and closing balance 37,500. I posted all the items related to the liabilities. Let's move on to the Asset side values. Non-current assets, intangible assets, goodwill. Opening balance being 0, closing balance being 7,500. Property, plant, equipment, schedule number 3 already posted. Inventories, we have the adjustments. Stock. Opening balance being 82,500. Closing balance can be 69,000. Cash and cash equivalents. Opening value being 1,125. Closing balance 8,250. 7,125 will be the summation of the 3 items. Other current assets. Other current assets. And trade receivables. Trade receivables, what happens? Decrease, right? Decrease in debtors. 64,620 decreases to 32,073. Sorry, 52,073. 12,547. As decreased, no, it released your cash balance. Prepayment decreases. Prepayment. Then it also releases your cash balance 1,777, I think. Right. So I have recorded all the items given in the balance sheet. So over. See, all these kinds of illustrations in financial accounts, you need to understand the asset account, liabilities account, shareholders accounts, as well as reserves and surplus. Finish of posting, first of all, that work can be done in a matter of 2 to 3 minutes. Then your load will go off. So now you are going to incorporate only these items so that the sum seems to be pretty simple. Is that okay? Now let's start with first one. These two. During the year, there is an interim dividend payment. 19,500 was paid. So dividend paid. Dividend paid could have been debited to the P&L account. As it is not being related to operation expenses, you remove it by adding it back. And this may be a financing item, so I subtract from here dividend paid. Dividend paid. 19,500 minus it. Another company were purchased for 37,500 payable in fully paid up equity shares. Such assets were stock, so what are the items purchased here? Out of 37,500, stock 16,000. So we issue bank to equity share capital, but we don't get cash for issuing the bank equity shares. We are getting stock 16,230. Machinery 13,770. Goodwill 7,500. Parallelly, I have to record that in that concern account, stock increases by 16,230, right, by issuing equity share capital. Goodwill also we received due to issue of the equity share 7,500. Machinery, by issuing the equity share capital, we are getting this one 13,770. Right. That's all. Now, in addition, these are the things also being incorporated. In addition, plant at a cost of rupees 4,237 purchased plant bank by way of cash payment 4,237. This will be investing activity. So purchase of machinery purchased 4,237. 4,237. Is that okay? And the following depreciation written off, depreciation on property as well as machinery. For property 3188, for machinery 8070. In property 3188, oh, depreciation, it reduces the asset value. So depreciation 3188, and for machinery depreciation 8070. Income tax during the year amounting to rupees 21,578 was charged to the provision for taxation. Was charged means payment is made. Okay. 21,578 paid, and this amount is charged to the provision for taxation bank. So next entry will be here. Cash from operation before tax minus tax paid. Tax paid in this case being 21,578. Balance being cash from operation after tax in net. Now, finish up tallying the others one after one. If I tally the property, hope it gets tallied, I think, right? So no more adjustment required. 1,11,375. 1,11,375. Machinery tally. What's the value? 1,02,720. 1,02,720. Goodwill also tally. And stock value 98,730. 98,730. So 29,730 rupees worth of stock decreased, maybe cash realized. So here decrease in stock 29,730. It is not directly comparing with the opening and closing. Opening 82,500, because of issuing the equity shares, the stock increases to 98,730. Later on decreases to 69, means the overall decrease is 29,730. Clear? Equity share capital tally. And what about the provision for taxation? 59,078. 59,078. Here 29,078 transferable to the P&L account. Here tax provision 29,078. Now find out the cash from operation before tax. Total value 52,440, cross verified. From that, this will be subtracted to get the cash from operation after tax 30,862. Machinery purchased being outflow. Dividend paid also outflow. You add these outflow with this amount. Ultimately, you will get 7,125. Clear? Hope it is now tallying. Yeah. Shall I move on to the next one? Come on. Once it is over, text me. We'll move on to the next illustration. Seventh. Okay. Seventh question. One of the comprehensive illustrations. Balance sheet, notes to accounts, and adjustments. Also, we have almost 8 adjustments. Prepare cash flow statement under indirect method. Now, open all the required formats here. Make it faster. So, usual thing. Open all the ledger accounts where there is adjustment. Cash flow statement. Cash from operation. Cash from investing. Cash from financing. You add up all these things. Cash from operation. Cash from investing. Cash from financing. Add opening cash balance to get the closing cash. First, let me finish up the notes to accounts. 1, 2, 3. Yes. Equity share capital. I open all the ledger accounts here. Equity share capital. Opening balance being 1000. Closing balance being 1200. 9% preference share capital. Opening balance 300. Closing balance 500. Almost all the account are having the adjustment. So it's better open everything. GR 350 decreases to 200. Increases means okay, but decrease means maybe there may be some bonus issue or possible. Let's see here. GR account. Yeah, open the ledgers. Finish copying. Copy. Try the last one. Open balance. Opening balance being 350. Closing balance 200. Securities premium. Securities premium. SP. You write along with me. If I use SP, you should not get confused if you are completing immediately after my posting. So opening balance 25. Closing balance 4. Trade creditors. Trade creditors. Increases. Increase in trade creditors. 95. Inflow of cash. Bills payable also increases inflow of cash. Value being 36. Hope now you'll be able to understand these 3 notes. Let's go for 4 and 5. One of my students who complete this question in 10 minutes. Okay, he's now chartered accountant, right? So he struggled with only these kinds of problem. He worked a lot for completing this within 10 minutes. Because of that, in his examination, in 10 minutes, he scored around 16 marks. This question is 15 marks question. In 10 minutes itself, 15 marks. Another 25 is okay for passing the examination. Maybe in another matter of 1 hour, he gets a pass mark. Thereafter, he plans to go for exemption. One chapter is enough. One chapter is enough to master or confirm the success. So one of the beautiful chapters. Land and building. Land and building. Opening balance 600. Closing balance 700. And plant and machinery. Opening balance 900. Closing balance 1150. Preparing this one up to now, it's very simple. It's very simple. Opening and closing. Prepaid expenses. Prepaid expenses decreased. So money released. 50 rupees is released. Advance tax payment. Advance tax payment. Okay. Opening balance being 80, closing balance being 105. While provision for taxation, last year's provision may be paid in this year. While making the payment, if there is any advance tax available, you first use that advance tax. Thereafter, shortage will be paid off. Shortage will be paid off. Is that okay? Over. So we have posted all these items. Let's go this one. Here, I need only this much. Share capital and reserve surplus already posted from schedule number 1 and 2. So I need to post only these things. 8% debentures we have. 8% debentures. One of the interesting illustrations. Okay. Opening balance 300. Closing balance 100. And trade payables, we have to go and refer schedule number 3. Other current liabilities, proposed dividend. Proposed dividend. Opening balance being 150. Closing balance being 260. Short-term provision, tax provision. Provision for taxation. Opening balance 70. Opening balance 70. Closing balance 100. Now, so here, from non-current investments to up to cash and cash equivalents. Non-current investments. No change. We assume we don't have any adjustments. You can skip it. If there is an adjustments, we'll get back to that. Inventories. What happens to inventories? Decrease in inventory. Decrease in stock. If stock decreases, cash realized 10 rupees. An increase in trade receivables, debtors, your money is locked. So 90 rupees outflow of cash. And cash equivalents, initially we have 100. At the end we have 95 rupees. So we have posted all the items given in the balance sheet. You have to finish up this posting in matter of 5 minutes. That's why I always recommend you to go for Mastering the non-profit organization, single entry chapter solved out. Where all these ledgers you prepare a lot. It will have the subsequent applications even at your final level. Okay. Now we'll go for adjustments. Start with adjustment number 1. Adjustment number 1. Depreciation charged on building and plant and machinery during the year 2021 were 50 and 120 depreciations. For building, so I'll put the value here, net profit, depreciation for building, plant and machinery. For building, 50, for plant and machinery, 120. Addable item. Second entry, it should be posted to the concern account. In building, depreciation being 50 and plant and machinery depreciation being 120. Working note number 2, additional information number 2. During the year, old machine costing 150 was sold for 32. Its written down value being 40. Forget about the costing. Today's written down value 40, sold for 32. So we lose around 80 rupees, 8 rupees, and we get cash 32 rupees. So bank 32 rupees. And loss on sale also decreases the value 8 rupees. Double entry. Loss is debited to the P&L account. It means it should be addable here. Loss on sale. Sale of plant and machinery 8. Cash realized, sale of machinery. Sale of plant and machinery 32 rupees. 32 rupees. Third one. During the year, income tax for the year 1920 was assessed at 76. 1920. Okay. We are talking about which year? 2021. This opening provision, we might have created for the previous year, paid in this year after the confirmation. The confirmation is around 76 rupees. Though the actual tax payable from this being 76, a check of rupees 4 was received along with the assessment order towards refund of income tax paid in excess. So we made a provision of 70 and an actual verification, it came around 76. We paid the 76. From where you will pay? We have the advance tax. So from this advance tax, I'm going to make the payment. I'm not going to pay in cash form, advance tax. How much? 76. Here, provision for taxation. 76. But already advance tax paid is how much? 80. Understand? Now I'm going to link these opening values. I thought the tax payable may be 70. I created the provision 70. Already I paid advance tax 80. While real tax payment, I confirmed that the tax liability being 76. Now the 76 is not paid out of bank because already we have advance tax. So from the advance tax, we made the payment. Here the advance tax is excess. If the advance tax is lesser, balance could be paid in the form of cash, but advance tax is excess. Informed to the government, I have paid the advance tax, again, means excess of the tax required. In that case, you will get the 4 rupees refunded back. You will get the 4 rupees refunded back. Received along with the assessment order towards refund of income tax paid in excess by way of advance tax in earlier year. Clear? So I had to finish off complete thing here. Now, by tallying the provision for taxation 176, 106 increases due to the current year's provisions. Current year's provisions 106 we created by debiting to the P&L account. And in advance tax, 185, 185, 105 excess is nothing but advance tax paid for this current year may be adjustable the next year. Clear? Now, the amount debited to the P&L account being 106, add back, tax provision. Actual tax being 105 advance tax, refund 4 you can net off this, 101 will be considered as tax paid here. Tax paid. Cash from operation before tax minus tax paid. Tax paid in this case being 101, 105 minus refund rupees 4. Clear? One of the interesting illustrations. Next, fourth one. Proposed dividend for 1920 was paid during the current year. Naturally, if nothing stated, you have to do that way only. This one is paid here. This one created here by debiting the P&L account. 150 payment, proposed dividend paid. 150. This one is the outflow of cash. Outflow of cash. Is that okay? Another one, 260 may be debited in the P&L account. Proposed dividend for this period. Next. Next. Fifth adjustment. 9% preference shares of rupees 300 which were due for redemption were redeemed during the year 2021 at a premium of 5% out of the proceeds of fresh issue of 9% preference shares. So they redeemed preference shares by issuing preference shares. Redemption of preference shares can be done by issuing either equity shares or preference shares or from the accumulated profits. You might have studied redemption of preference shares already. Our corporate accounts will see later on. Okay, that redemption of preference shares also included here. 300 rupees supposed to be redeemed. At the time of redeeming, we pay 5% extra. 315 we might have paid here. 315. So initially we have 300, bank, how much? 315. The additional 15 rupees is nothing but what? Premium on redemption. This premium on redemption is usually loss. If we have securities premium balance, we can adjust this premium on redemption in securities premium. 15 may be written off from the opening securities premium on redemption. Hope you will be now able to understand this. For this, you need to understand the concept of redemption of preference shares, right? As per the redemption of preference share, if you are paying excess to the preference shareholders, that excess payment premium on redemption can be adjusted in the securities premium, or you can later on adjust to the other resource. And here also we issued further shares. Because of that, we collected 500 rupees, 815, 815. 500 rupees worth of preference share issued bank. Hope now you'll be able to understand all these logics. So we have issue of preference shares, 500 rupees, and we have redemption of preference share capital, 315. This is outflow, that is inflow. Any of the outflow can be managed out of the inflow money. Inflow money is 500, outflow money being 350. We manage this. The excess payment loss is adjusted in the securities premium account. Now, sixth one, bonus shares were issued to the existing equity shareholders at the rate of 1 for every 5 shares. 1/5 bonus share is given. Okay. Now, 1000, 1/5, 200. 200 being the bonus share. For the issue of bonus share, you have to use only the reserves. We have the general reserve and securities premium also we can use. 25, 15 used and closing 4. Debentures were redeemed at there also. Debenture redemption happens at a premium. That premium can also be adjusted. So here I am going to use completely GR for the bonus share. GR for what? Bonus shares. In GR I am going to charge this 200 equity share capital issue bonus share. And debentures were redeemed at the beginning of the year itself at the rate of 3%. Debentures. Year beginning 300, year end 100 means 200 rupees worth the debenture might have been redeemed at a premium of 3%. Then 6. Bank. 206 may be paid. That 6 rupees excess payment is premium on redemption. The premium on redemption for preference share as well as debenture 6 rupees. I transfer that here. Clear? So while redeeming the preference share we lose 15, while redeeming the debentures we lose 66 rupees. Overall 21 rupees we lost. That's why the securities premium reduces from 25 to 4 rupees after these losses. And interim dividend paid during the year is 50. Interim dividend. Interim dividend charged to the P&L account. First you have to add this 50. And interim dividend is also paid related to the financing item. So I post that in the cash from financing 50 rupees negative. Is that okay? Now the redemption of debentures 206 should be posted here. I missed to post redemption of debenture. How much is that? 206. Double it. Apart from that, I told you no. We have the hidden adjustments. If the preference share given with the rate of interest and debenture also with rate of interest, this will be considered as hidden adjustment. The preference dividend interest may be debited to the cash from operation and then subtracted from the cash from financing. But I skip this for the simplification, right? So last illustration we solved that way. So here I remove the hidden adjustments. Okay, come close the books of accounts. Equity share capital got tallied. Preference share capital got tallied. GR 50 rupees shortage may be transferred from the P&L account. So transfer to GR 50 rupees. Securities premium tallied. And land and building 150 increase due to what? Purchases. Purchase of land and building 150. Outflow of cash. Plant and machinery also there is an increase. Total being how much? 1,310. 410 increases. Isn't it? Purchase of plant and machinery 410 outflow of cash. Provision for taxation, advance tax, debenture got eliminated, or all these things are tallied already. That's all. Now you finish up tallying the cash flow statements. Now, what about the net profit? Oh, I missed to post that. 200 and 300. The difference between these 200 is the current year profit. Okay. Now, cash from operation before tax 845. Okay, you get this. Minus 101 744. Cash from investing 528 outflow. Cash from financing 221 outflow. Then if you add up these three, net value being 5 outflow. Now it's tallying, right? Now, usually in your text, they start with the profit given in the books. Any profit given in the books here? No, not required then. No need to worry about this. Okay, anyhow, we have completed fully. Make a note of it. One of the lengthiest illustrations. The following additional information is also relevant for the preparation of the statement of cash flows. First, we have been given 5 adjustments: balance sheet, assets and liabilities, and profit and loss statement given. Whenever the profit and loss statement given, we will not consider that. What we have to do? We have to take only non-cash, non-operating items from this. That will be the adjustment. And finally, we have 3 more adjustments. Okay. Now, prepare as usual. You try it yourself, this much. To the extent what you are able to try, you can try along with me. This one is one of the interesting illustrations. Actually, this sum is available for +2 students of CBSE. Anybody from CBSE? No CBSE students. Okay, this sum is available at your CBSE level. Do you know? Huh? Not remember. At least cash flow statement. Because I was asked to address for the +2 students, especially this cash flow statement. Seeing this illustration, I solved this. It took almost 1 hour to finish off for the +2 students. Not 1 hour. Took some more extra time also, because redemption of preference shares background knowledge also you need. So automatically it consumed more than 1 hour to 1.5 hours almost to explain the redemption of preferential logic and the incorporated. After the 1.5 hours, the class is pin drop silent. Will it come in the examination, sir? Right. So now it's coming for the CA and CMA level. Let's see. Cash from cash flow statements. Cash flow statements, sorry. Cash from operation. Cash from investing. Cash from financing. If you add up 1 plus 2 plus 3 with that opening cash, you will get the closing cash. Now, let me finish up the liability side items first. Share capital. Share capital. Opening balance. How much? Hmm? Thousand? Opening 1,250, closing 1,500. Years given in totally different angle. This happened once all the students got stuck here. Solved, assuming this may be the first and second. But here the number is totally different. First given the latest and then oldest. 1,250 is the opening balance. Closing balance being 1,500. Reserves and surplus. We can find out the net profit for the year. The difference between these two. 2030. 2030. Non-current liabilities. Opening balance being 1,040, closing balance being 1110. And items related to current liabilities. Trade payables. Trade payables decreases. How much? 1890 to 150. 1,740 outflow. Decreases means you may pay this. And we have been given interest payable. Interest payable. Otherwise, interest expenses. Interest payable in the beginning 100, opening balance. Closing balance 230. Short-term provision. Provision for taxation. Provision for taxation. Opening balance 1,000. Closing balance 400. Always cross check whether I am posting it properly or not, because the first year is the latest and the second year is the oldest one. I may mismatch also. That will be usually happening always. Now, asset side. Non-current assets we will try to finish up first. In non-current assets, we have been given accumulated depreciation model. Property, plant, equipment. And accumulated depreciation on this. Accumulated depreciation on this. Property, plant, equipment, opening balance being, come on. You have to write at its own original value. Okay, opening balance should be here. Okay. Hmm. 1,910. Closing balance should be 2,180. In case of accumulated depreciation, opening balance should be in the credit side. Opening value being 1,060. Closing balance is 1,450. You need to know the provision for depreciation model here. Just think over if this illustration is for +2 students. And non-current investment. Non-current investment. Opening balance should be in the debit side. Closing also 2,500 in the credit side. Both are same. No change. Okay. Let's move on to the items of current assets. Current investment. Current investment increases. $135 to $670 increases means outflow of cash. 535. Okay. That is part of investing activities. I'll open the account for this current investment. It's not current assets for the operation purpose. Opening balance being 135, closing balance being 670. Inventories decreases stock. How much? 1,050 cash realized. Trade receivables increases. 500 outflow of cash. Cash and cash equivalents in the beginning 25, in the end 200. And other current assets, interest receivable, interest, income angle. Opening balance being dash, closing balance being 100. Clear? Now, adjustment number 1, first page. The amount of 250 was raised from the issue of share capital and further 250 was raised from long-term borrowings. So, bank issue of equity share capital 250. Then long-term borrowings, bank 250. These are cash from financing, issue of equity share capital 250 inflow, long-term borrowings 250 inflow. Is that okay? Working note number 1 is over. We'll go for the working note number 2. Interest expenses was 400, of which 170 was paid during the year period. 100 relating to the interest expenses of the prior period were also paid during the period. Very interesting one. This is related to the advance payment of interest outstanding interest and all, similar illustration. Interest expenses 400. What is journal entry? Interest to bank and later on debited to the P&L account. To the extent amount is considered as expenses debited to the P&L account, so P&L account debit to interest being 400 rupees. This 400 debited to the P&L account, but interest is what? Financing activity, so it should be removed. Interest debited to the P&L account is removed. Removed means it increases the profit. See, finance cost 400. But the actual payment is how much? 170 and prior period outstanding 100. So this 100 plus from this 170, 270 was paid. Banked. 270. How? 170 for the current year's interest, the outstanding of the previous year 100, together with it is paid 270. Clear? Actual interest payment for the current period will be appearing in the cash flow statement. And this interest is due to the financing activities. So interest paid. This value being 270. Interesting, right? You might have now recollected with the normal journal entry and other things, ledger preparation. There in journal entry, I told you how to calculate advanced and arrears and all. So that's all about here. Now, if you tally, then it gets tallied. 500. Next. Dividend paid was 1,200. Dividend paid. Dividend usually proposed 1,200. Dividend paid is actually financing activity outflow 1,200. 1,200. Tax deducted at source on dividend received. Okay. Tax deducted at source on dividend received, including the tax expenses 300. Amounted to rupees 40. Now, what is the tax expenses? 300. Tax expenses means it may be debited in the P&L account. This one. So, very interesting one. P&L account 300 rupees tax expenses. This tax expenses includes for the dividend received 40 and balance 260. The amount debited in the P&L account should be added back, provision for taxation. The value being 300. Now, by tallying this, 1,300, 1,300, 900 is what? Bank paid. But this 900, 40 TDS related to the dividend, balance 860 is related to the operation. Tax deducted source on dividend received. Dividend received is for what? Investing. You may invest somewhere, for that investment you are receiving the dividend. As you are receiving the dividend, it's an inflow of cash related to the investing. Further, if you are paying the tax, it's related to investing activity. So, tax paid for investing activity, for dividend, investing activity 40 minus. For operation, from here you have to deduct this value being 860. Cash from operation after tax, cash from operation before tax. One of the interesting concepts. All these things are related to fundamental accounts only. Next. So, during the period the enterprise acquired fixed assets 350, the payment was made in cash. Fixed asset acquired 350. Purchase of fixed assets 350. Outflow of cash. Here 350. Bank purchase of fixed assets. Property, plant, equipment. Collectively it is named as property, plant, equipment. Okay, this page is over. This page is over. This page is over. And from the P&L statement, you have to identify non-cash, non-operating items. Interest income. Why do you get the interest? Investing. So it should be an investing activity. 300 rupees. Where it should be posted? Interest income. Okay. P&L account. The value being how much? 300. That should be subtracted here. Interest income. Why this 300 is subtracted? Because it's non-operating item. You will be getting the interest for the investing angle, investing purpose. You credit it in your P&L account. Actually, it is not related to the operation. So remove that income. If you remove, the profit will go down. Then any of this income, no, where to be posted? Sir, it is related to the investing. Put that value in investing angle. While posting that in investing angle, actual collection will be posted. Interest income for the period being 300, but still 100 rupees recoverable, 200 rupees may be collected. So interest on investment received. 200 rupees is income. 300 rupees credited, but actually received only 200. Hope you will be now able to understand how to pick the items from the given P&L statements. Dividend income. Dividend income. Income from investments. Okay. Dividend income should be removed from the P&L account. And it should be investing angle, dividend received, 200 rupees. Is that okay? This is dividend paid. This is dividend received. You have to understand the difference between these two. Cost of sales, okay. Depreciation and amortization, non-cash item, 450. Add the depreciation back. Depreciation 450, and in accumulated depreciation profit and loss 400 or 450. 450. Is that okay? Administration and selling related to the business. Foreign exchange loss, I have to incorporate that. Wait. After referring the adjustments, if any, we'll adjust this. Keep it pending. And extraordinary item, insurance proceeds from earthquake disaster settlement 180. Okay, you are receiving this money. That should be better, show it separately. Okay. So what do you do? Insurance claim. Insurance claim. Value being 180 is removed and added insurance claim. This is an extraordinary item. So I need to show the business operation profit without extraordinary item. Thereafter show profit including the extraordinary item. So you first subtract, then add. That's all. Whatever it may be. Whatever it may be. Here, extraordinary item is included. And tax also incorporate. So with that, this one is completely over. Plant with original cost 80, Accumulated depreciation on this 60, WD value being 20, sold for 20. Then we don't have any profit or loss here. How can we record this? Okay. By telling the accumulated depreciation, any asset sold, the accumulated depreciation on that is transferred from here to there. Property, plant, equipment 60. Here 60. Accumulated depreciation. And we get the collection also bank 20, no profit, no loss. 60 double entry, this 20 should be posted here. Sale of property, plant, equipment. Sale of property, plant, equipment. Clear? Now, if you tally the accumulated depreciation, it gets tallied, I think, 1510. 1510. Accumulated depreciation is over. Foreign exchange loss 40 represents the reduction in carrying amount of short-term investment in foreign currency designated bond, arising out of the change in exchange rate between date of acquisition and investment date. So foreign exchange loss, this 40 is due to what? The investment value getting affected. The investment value, current investment given. Hope you will be now able to understand why I have opened this account separately. Any loss will be now added back. Forex loss 40 added back. Is that okay? Now it should be adjusted in the current investment. Here 40. Put the value 40 here. Like depreciation. Forex loss is like depreciation. Depreciation posted here? No. Okay. Similarly, I post the value here. P&L account like loss. Then 710, 710. Balance will be purchase of current investment. What's the value? 575. 575. Now, purchase of current investment. Actually, we purchased 575 rupees worth investment. 135 plus 575, it should be 710. But due to the forex loss, 40 rupees reduced, the closing value is 670. This forex loss is similar to depreciation like. In case of forex gain, it may be appreciation like, you can put the other way. Is that okay? Also one of the interesting concepts here. Sundry debtors and creditors include among amounts relating to the credit sales and credit purchases only. You don't need to do any adjustments. Usually, this will be related to the credit sales and credit purchases only. We have completed all this posting. Now, try to finish up tallying all these things. Share capital closed. This one 1290, 1290. 180 non-current liabilities increases or decreases may be repaid. Repayment of borrowings, long-term borrowings, repaid. The value being 180, outflow of cash. Outflow of cash. This one is also tallied. Come on, property, plant, equipment. 2,260. 260 or 280? 260. This is 350. Okay. So 2,260. Tallied. Accumulated depreciation tallied. It has no adjustments. Come on, find out the value. Before the insurance claim, what is the value you are getting? 2,550. This is cash from operation before tax, before extraordinary item. If you are adding the extraordinary item, cash from operation before tax could be 2,730. Tax paid is subtracted to get the cash from operation 1870. And purchase of current assets minus. Where? Huh? 200 only received. This one only, right? 200 received. Here is 300 income, received is 200. Come on, get me the value. 545 outflow. And tally this 1150 outflow. Inflow, these two are outflow, the ultimate value being 175 by summing up the three. Now, see here, the net profit here being 3,230. Most of the books, they will start with the net profit given in the statement of P&L account. So, profit and loss 3,230. Is that okay? From this, what you have to do? You have to now do some adjustments. 3,230. Usually 3,230 you have no, will not have dividend paid or tax paid, like appropriation will not be there. Dividend and transfer to GR, those things are now added here. What is the dividend paid? 1,200. If I subtract this dividend paid, what's the value you are getting? 2,030. If you start with that, this dividend expenses cannot be shown here. So anyhow, the thing will be same. That's why usually I never bother about the net profit given in the P&L statement. You will start with what? Net profit transferred to the balance sheet. From there, if you do, then it will be similar to the double entry like you can solve. The same illustration in text I have solved under direct method for the arriving cash from operations, that you can try it yourself in your home. Cash from operation in direct method. For that, you need to know what is the collection from debtors and payment to the creditors, as well as the real purchases and sales. For that, you need to open the trade debtors, trade creditors account and inventory account. And then you can prepare the cash from operation in direct format. Collection debtors, payment to the creditors, and any other operational expenses paid will be subtracted. That's how you can do. Try that one yourself. Hope you will be now able to understand.